Hey, what's going on, guys? It's your boy Freddy. Welcome back to the channel. As many of you guys may have noticed, I haven't uploaded a video for a while, and that's because I've been hiding from this stock market, which has absolutely ransacked a lot of the gains that we had seen within the portfolio throughout the year. Jokes aside, if you guys are solely large cap index fund investors, you may have not even noticed a major drop to your portfolios, as the S&P 500 is only down about 4%, the Nasdaq down about 6%. But if you guys are in the small cap game, you may have noticed that the Russell 2000 was down at times 11%, which is considered a correction. In my opinion, I believe that the only reason that the S&P and Nasdaq haven't dipped as much is because they're being propped up by the stable tech companies. And if these companies start to rotate down more drastically, then we will start to see more pain across the market. Right now, there's a few uncertainties in the market. For example, the Omicron variant, which sounds like the newest Pokemon game to drop, as well as inflation concerns which have ravaged the market for quite some time now. The concerns regarding the Omicron variant are due to the fact that we simply don't have enough information regarding the effects, how contagious it is, and if it's able to break down the vaccine walls. So the uncertainty regarding this variant definitely do have some merit because we don't have enough information and research regarding it and what it could do to the overall global economy. For example, if we go into more global lockdowns, it could have a massive effect on supply chains that are already extremely sensitive due to the start of the pandemic and everything that it brought with it. Powell of the Federal Reserve has said that greater concerns about the virus could reduce people's willingness to work in person, which would slow down progress in the market and intensify supply chain disruptions. Some preliminary findings are showing that it isn't as severe as we once thought, but we should have some more information coming out over the next couple weeks that does shed some more light on this variant. With the buy the dip mentality that is entrenched in the market, we are seeing big green days that come after red days, so it's definitely not out of the realm of possibility that this could be the bottom of the dip. At the same time, however, these pressures could continue to persist into the new year, so there is plenty of more pain that could be seen. Let's take a look at my portfolio and dividend tracker and see what I've been buying amidst all of this panic. Over the last month, I have been trying to consistently invest in the market as we have seen these dips. My goal is for the long term to invest and dollar cost average consistently into the market to give myself the best chance of succeeding. At the same time, however, I can't overlook the fact that I do want to buy the dip as much as I can. It is for this reason that although I have worked to consistently invest over the last few years, I like to invest heavily during dips like the one we're seeing now. Looking at the transactions I made over the last month, we can see that I purchased one share of RBC or Royal Bank of Canada. There are two reasons for this purchase, one being that I wanted to diversify my Canadian bank holdings because right now I'm exclusively in Bank of Nova Scotia, and although I like the company a lot, I want to diversify within the Canadian banks, and I believe that RBC is a solid company and offers good steps towards further diversification. I could have, of course, invested in a Canadian banks ETF like RBNK. However, although you do get exposure to all the Canadian banks, they do have a high management expense ratio at 0.33%, which in the long run can definitely be detrimental and lower your potential gains, as the Canadian banks are historically going to have lower returns because of the high dividend, and on top of that, you're getting a lower return due to the high expense ratio. The other reason I wanted to invest in the Canadian banks and RBC specifically is because they're starting to raise their dividends as well. RBC and BNS are both raising their dividends by a whopping 11% as the restrictions that were put in place to limit their increase in dividends has now been removed, and they're free to increase their dividends. And this is absolutely amazing that we now start to see the dividend aristocrats finally raising their dividends after almost 2 years where they have been flat. I have, of course, also been buying ETFs, as this is a solid way to be able to take advantage of the market, as we're able to buy the market itself. You always see people trying to beat the market, but research does dictate that even 92% of actively managed funds, which have the sole job of trying to beat the market, don't beat the market. So I see this as a way that if you can't beat them, then match them by buying the market itself and riding the waves of the returns of the overall market. Taking a look at our holdings page in our dollar profit and loss section, we can see that VFE still makes up our largest holding and has the most dollar return at over $1,000 within the portfolio. However, it only has a 22% return. When we compare this to Tesla, which has a $630 profit and at the same time a whopping 164% return, it might seem like that I should have gone in all on Tesla, And of course, if I did do that, I would be up way more in the portfolio than I am now. However, because I don't have a crystal ball, in my opinion, chasing companies with huge potential like this should only make up a small percent of the portfolio, because at the same time you see big highs, you could also see massive dips like the one we saw at Jumia, which has a $500 loss and a 75% profit and loss. Limiting the allocation of volatile companies in the portfolio while at the same time having a strong backbone with less volatile returns like you find with ETFs like VFE, which track the S&P 500, or QQC, which tracks the NASDAQ, you're able to build a more well-rounded portfolio. And of course, my portfolio is still heavily weighted towards technology because the S&P and QQC are heavily weighted in companies like Microsoft, Google, Amazon, etc. You'll still be able to get more well-rounded. Given this, I of course definitely want to continue to diversify out of technology, but I also want to make sure that I'm getting the best bang for my buck because I have a long-term time horizon. And in my opinion, I believe that the American economy is one of the strongest and most resilient economies in the world and has the best potential for return. And for the time being, I'm going to continue investing in these two ETFs, but I am looking to broaden my ETF allocation with more global ETFs which track different markets like Asia or Europe. One company that I did want to go over is Algonquin Power and Utilities. Over the last year, this company has been on a steady decline. One reason for this is that they did have a lot of issues come up at the start of the year with things like the Texas storms, which caused issues to their overall infrastructure in Texas. However, they just released their Q3 reports and they're seeing some amazing financial numbers. And in my opinion, this company is definitely undervalued at the moment. I'm definitely going to have a video coming out regarding this company and the recent reports and everything that's going on with the company, because I'm a shareholder and I want to increase my position in this company quite dramatically. And I want to share my findings with you regarding this because they offer some amazing growth potential as well as a solid dividend growth that they have as well. Checking out the dividends received page, we can see that we only got 2 dividends, both from Ryokan, one in my non-registered account and one in my TFSA. The reason that I'm now investing in a non-registered account is because I have maxed out my TFSA contribution limit between WealthSimple, Questrade, and my account at RBC. So until the end of the year, which is when the TFSA contribution goes up by $6,000, I will have to invest in an unregistered account for the time being. Compared to the TFSA, which allows you basically unlimited returns tax-free for the money that you contribute, a non-registered account does mean that you will have to pay taxes on your gains when it does come time to sell. But this is of course a way better option than simply not investing and having your money deteriorate and lose value through inflation. You also never know what the tax situation is going to be like when you draw down from your portfolio. So it's always best to maximize the money that you can make now and the money that you want to invest by making it work for you. Next, let's head on over to the visualization page, which is my favorite page of the portfolio tracker because it offers information that you simply cannot get in such a convenient and visually appealing manner from the brokerages. And by the way, if you do want to take a look at this portfolio tracker and start your investing journey towards financial independence, there's going to be a link in the description down below where you can go and check out the portfolio for yourself. Taking a look at the dividend growth chart that we have on this page, we can see that for the month of November compared to October, we saw just $1.28 in dividends compared to the almost $45 that we saw in October. This is because many of the companies that I have in this portfolio pay their dividends on a quarterly basis, so every 2 to 3 months I do see a bump in dividend and then it subsides as we wait for the next round of dividends. But Ryokan does pay a monthly dividend and that is starting to grow as I increase my position in the company. Taking a look at the overall portfolio summary, we can see that we are up to a total portfolio value of $14,232.42 with a total amount of deposits of just under $12,000. Our monthly dividends are up to $22, and by the end of the year, I want to get this up to a solid $25. Some of you OG viewers may remember that at the start of the year, I did have a goal of getting this to $50, but this did change as my priorities shifted from simply investing in dividend companies to investing in growth-oriented companies, as I did more readings and more research and found out that because I have a long-term, about 15 to 20 year time horizon, I want to maximize and squeeze every dollar that I can from my deposits, and to do that, I have to invest in companies who see more growth potential than more solid dividend companies. I still want to continue investing in dividend companies to create this base and foundation for myself, as eventually when I do start to live off the portfolio, I will transition and sell from these more growth and more volatile companies to more stable dividend oriented ones to get that constant stream of passive income. Taking a look at our holding breakdown, we can see that we are starting to stray away from that 50-50 split that we did have between our ETF and our individual stocks, as I have been buying mostly ETFs during this market dip. I want to continue to increase my position in the banks as well as TELUS, as I definitely think there's a lot of growth potential to be had with them, and it is a very solid and stable business model. Another company that I want to continue to increase my position in is Ryocan, as the monthly dividend is very solid and they also have an amazing and steady business model. With that said, you guys, thank you for watching all the way through to the end. And if you did enjoy, remember to hit that like button down below, as it really does help the channel to grow, and consider subscribing for more videos like this to come. Take care.